Hey everyone, welcome to another Own More Doors podcast. Juan Weezar here, and I have Cody Charnel, one of our brokers here in Sage Real Estate, with us in the podcast studio. And we're going to be covering insights of real estate, what's happening at multifamily. We're going to be talking about laws that are being proposed, ones that are being canceled out. We're going to talk interest rates, inventory, sales, what is happening. Cody, man, thanks for being here today.
Yeah, thanks for having me back.
Cool, Cody. So I'm just going to get straight into it, man. You and I last week were on the phone with one of the analysts over at CoStar. For people who don't know, CoStar is kind of the leading data information when it comes to commercial real estate. And so luckily we have a good relationship with them. We've had them on the YouTube channel. We've interviewed them. And sometimes, listen, they reach out to us and they want to know, hey, what's happening at the broker level, at the level that Cody and I operate at, so that they could get on a good idea. You know, when you're with CoStar, these analysts are looking at information all the time, just data. But the reason why they will reach out to us from time to time is to see, well, what's really happening? What are sellers thinking? What are their motivations? What are buyers thinking? And so Cody came up with something really interesting that he had seen, and I'm going to let him talk about it. And Cody spends a lot of time analyzing property for his investors, putting them in positions to win. And so what he's going to talk about next is pretty telling, and we'll discuss why this might be the case.
Yeah, so I'm always trying to look for trends and always following pricing in different neighborhoods in Long Beach. And one of the things that we discussed with the analyst from CoStar was how the difference in pricing between like your A neighborhoods in Long Beach and your more like workforce housing, the gap in pricing has shrunk a lot in the last 2 years. And this is something that I just kind of noticed from analyzing deals, but actually today I went through and pulled all of the data just to have it down on paper and explain it well. But basically what I did is I compared two zip codes in Long Beach. I compared 90802, which is Alamitos Beach. So these are nice properties, basically south of 7th. They're between the Sand and 7th Street. So beach properties. You typically see more professional type tenants living there. A lot of luxury units in this neighborhood. And I compared that to 90813, which is a little bit more inland, more workforce housing, a little bit less nice. And I looked at all of the closed sales from 2022 and compared them to all of the closed sales in 2024. And what I found was pretty interesting. It kind of went in line with what I was noticing when I was analyzing properties. So to give you the data, so we're going to start with 90802. So this is the nice neighborhood. In 2022, those properties sold at an average of 16.6 times gross. And if you're not familiar with gross rent multiplier, it's a metric that we use to compare buildings to one another. It's kind of like cap rate, but simplified a little bit. 16.6 times gross basically means that you take the gross income that the building makes, multiply it by 16.6, and that gives you the sale price, right? So the lower the better when you're buying. So 90802, it was 16.6. In 2024, for that same zip code, it's fallen to 11.7 times gross. Okay, so big decrease there. The 90803 zip code, so this is a little bit less nice workforce housing. In 2022, those buildings were selling at an average of 14 times gross, and now 2024, we're seeing an average of about 10.8 times gross. But what's interesting, if you compare these two neighborhoods, so looking at 90802 versus 90813 back in 2022, there was a difference of about 2.6 times gross comparing those zip codes. And now fast forward to 2024, there's only a difference of about 0.9 times gross when you're comparing, GRMs in the two neighborhoods. So basically the difference between pricing from the nice area to the less desirable area has shrunk quite a bit. So
a lot, a lot. And I think when people are thinking, well, 2.6, that can't possibly be that much, or the difference, sorry, it's hundreds of thousands of dollars because it's based off the annual gross income.
Right. And some of these buildings, actually, most of them are going to be making over 100 grand a year. So 2.6 times gross, that's 260 grand potentially.
Right. So, okay, so let's just take it from the top. Okay. We're comparing 2022 and 2024. In both of those zip codes, I think anyone listening who's been following our channel would say, okay, well, Juan and Cody have been talking about sales are down, prices are down, cap rate is up, you know. And so the fact that they both went down is expected. So we're good there in terms of like both zip codes, gross rent multiplier went down. The problem is that what you would call more of a, let's just call it C class neighborhood, just for now. Okay. Instead of workforce, just C class, didn't go down as far as the A class neighborhood when comparing it to a gross rent multiplier. And by the way, for anyone listening who's going to send me a message, we're only focusing in on gross rent multiplier, but I would tell you that if we took it to the cap rate, you would still see the same because both of those are derived from income. And so just for now, we're just looking at what we call GRM. Cody, why do you think this is happening?
Oh man, it's a good question. I'm not exactly sure. Actually, something else I wanted to add. This is just for 5 unit and up buildings.
Okay.
So we've talked about this in the past. You know, the pricing on 5 unit and up buildings has come down a lot since 2022 because interest rates have gone up so much, right? So the type of financing used on a 5 unit and up building is typically only fixed for 3 or 5 years. So as interest rates have gone up, people have had to refinance or try and sell a building. You know, when a new buyer is coming in with this higher interest rate, they have to put a lot more money down to make the numbers work. So I think that's one reason that pricing has come down across the board. The reason that pricing came down more in a nicer area, I'm not exactly sure why that happened. It's sort of an anomaly, but it presents an opportunity where if somebody is interested in investing in a 5 unit and up building now, we're seeing really good opportunities in nicer locations.
So let's talk about, you know, when we created this show is that I wanted to educate and I wanted to inform and I want to give people the tools so that they could go do something. They could go do something. So right now, the way that I'm looking at this, Cody, is if I'm a buyer and if I'm looking at 5+, so typically buyers that are looking at 5 units or more might be a little more experienced. Like someone's not going to typically start off with the first 8 unit building as an investment. Most times they start off with the 4 and then you and I help them trade into something bigger. So if I'm looking at this, I'm looking at the fact that in the A neighborhoods where quite frankly, that's where I want to own. Listen, I own stuff everywhere, right, Cody? So A, B, C, D, everything. Okay, all the above. So I know what it's like. If I'm looking at this, I'm calling someone like you. I'm calling Sage Real Estate and saying, hey, let's look at that A neighborhood. Because what we're seeing there is essentially a bigger price reduction.
Right. And I guess one important thing to point out, in the nicer neighborhood, the average sale price was much higher. So it was like 2.8 million. And when you're comparing that to the C neighborhood in 2024, the average sale price was about 175. So, you know, you're going to have higher sales prices still.
So, I mean,
but the
it's almost like
metrics
$1 million difference is what you're saying.
yeah, just
So-
based on the closed sales, right?
Yeah, and that's based off the average.
Right.
So, okay, so what we're telling people, it's like, hey, yes, pricing has come down more in the nicer neighborhoods, so you could potentially get a better deal. But what you just want to remind folks is that, yeah, but we're talking about another $1 million on a purchase price difference,
Right.
essentially. Yeah.
Right. But yeah, as far as, you know, the metrics go, you're getting really good metrics in the A neighborhoods right now. So if you can afford to be there, it's a great time to buy.
I'm thinking, Cody, when we talk about the difference in actual price, could it be that someone might say, well, could it be that that was overinflated? And could it be that it was so overinflated that there was room for it to come down?
I mean, that definitely could be. There was a big frenzy when interest rates were down. I remember, you know, trying to get buyers into stuff back in 2020, through 2022. And, you know, every deal had multiple offers. On commercial deals, you usually couldn't have a loan contingency or an appraisal contingency. And inspection, you could have 5 days. So basically, you're 5 days into the escrow, your earnest money is going hard, and you're basically just hoping you can qualify for a loan. I've never had anyone not, but anyway, yeah, there was so much competition at that point, and I think prices got bid up a lot for those, A location properties.
And I'm also thinking that in the C location properties, that's typically your starting barrier, and it's already lower to begin with, and it was lower in 2022, and it just maybe it could only just drop so much because maybe back to my first point is that maybe the nicer areas were slightly inflated, and so versus like they had more room to drop versus say a C neighborhood.
Right. One other thing I was thinking about, so as the fixed periods on these commercial loans adjust or expire and the loan adjusts, um, you know, back in 2022, if you were buying in an A neighborhood, you might have been able to buy with 35% down. And, when that rate adjusts, maybe that's not quite enough to get you into a new loan. So maybe it's harder for people to refinance those properties. And that's why prices have come down a bit more. Just one guess, but
Okay. Or maybe since most investors that we represent would love to buy a building at 30% down when it comes to 5+ units. And when you start increasing that because interest rates went up, and so now the investor has to come in with maybe 40, 50%, sometimes even more, maybe it makes it more difficult in the A neighborhood because now you have to put more down. And maybe when they look saying, well, the C neighborhood is not as bad and it's in the path of growth and it's getting better and there's still good rental demand there. And maybe there I could buy with 35% down. That could be the other driver as well, meaning that you only have so much money as an investor. You want to put as little as possible in most cases, and the C neighborhood gives you that option.
true. Yeah, that could be.
Yeah. And so the only reason we're bringing this up is that in most scenarios, if you would have said that the gross rent multiplier has dropped across the board, in most cases, we would have expected it to be the same.
Right.
That would have been normal. And what we're pointing out here is we're seeing an opportunity to let you guys know of this great opportunity.
Yeah, definitely. I would not have expected this. Usually you expect the nicer locations to retain value better. And in this case, for whatever reason, it's just there's an opportunity here where you can buy for cheap.
Cody, we have listeners nationwide, worldwide. And someone's going to say, I mean, I guess my question, do you think this is the same? Do you think this happened in Orange County?
Ooh, good question. I haven't looked at the numbers as closely, but I'd be interested to find out.
Okay. Yeah, I'm thinking some of the folks listening are probably going to raise their hand and say, "Hey, can you look at my area? Did that happen there as well?"
Mhm.
And maybe it didn't, and maybe it all went down. It lowered. We're going to tell you this: it definitely lowered. It lowered across the board. This is nationwide. 5+ units took a bigger hit on value,
Yeah.
and in some areas probably more than others, but definitely here in Southern California, cap rates rose and gross rent multipliers went down. And in both of those instances, when those things happen, values have come down.
Right.
Yeah. Let's talk about how far they've come down, Cody.
The
Values overall, just in general, not even A or C, just in general. Like, what are you seeing?
for the 5 unit and up buildings, it's about 20% from the high is what they've come down, at least just, based on what I've noticed. The 4 unit properties and under, there's still been a decline, but not as much. I know you know a lot about the 4 unit market, so maybe you could add to that.
Yeah, so here's what I've seen. I tell people, hey, when people ask me, well, how's the market? I'm like, are we talking about 5+ or 4 and under? So if we're thinking, hey, well, let's talk about fourplexes. And so I agree with Cody that we've seen anywhere between 20 to 25% decrease in the 5+ market. And so we know now when you're pricing a property, and we're fortunate enough that we get hired a lot to sell multiple buildings throughout Long Beach and the surrounding areas. And so when we're looking at a 5+ market, it's competitive. There's more inventory out there. Cap rates have risen, and so we need to price ourselves where we're competitive with everyone else. It's different at the fourplex level. Sometimes there's certain metrics, and a lot of the metrics that we've created to kind of simplify the process in-house here, we call it the 621 method. And our 621 method allows us to analyze a property with every possible metric that any investor is going to look at. Cody, you love the growth rate multiplier, and so do your clients, and it's a real great way to simplify comparing properties apples to apples. And other people, sometimes they look at price per door, price per square foot. And what I've noticed with the fourplex market, we've probably seen more of like a 15% drop in value. So not as high as the 5+. Sales are down significantly right now, but they're still trading. And the one thing that's really interesting, so, okay, sales are down, values are slightly down, 15%. That's on average. Now, some areas haven't really taken that big of a hit. The most interesting thing is that properties are even under this environment, on average, fourplexes are selling faster than they did like a year ago. So it's kind of an interesting thing where if I told you sales are down and then also prices are down, you would say, oh, it's going to take longer to sell a price. That's not always the case. But right now, when it comes to the fourplex market, Cody, we're experiencing like the least amount of sales than we've ever seen since I've been tracking this, like going back 7-8 years. Mm-hmm. And so and a lot of that is driven with two things. Interest rates went really, really high. And when a buyer buys a fourplex, typically they may not know what cap rate stands for, what it means, how to come up with it, because in most cases, people buy a fourplex because that's going to be their first safe multifamily investment. It's, I call it like the gateway investment. People sometimes will make a decision just based on location, and they may not factor like income as much. I'm not saying that we don't analyze. We're definitely going to analyze it that way, but I kind of know who the market's going to be for it. And sometimes they're like, hey, I like that area. It's down the street from my dad's house. I'm going to buy it. And that's the rationale, not, hey, the cap rate is so good on it when compared to everything else. So it's slightly different. When it comes to the 4 units, 3 units, 2 units, there's the motivation behind people buying it is slightly, it's more based on sometimes on literally curb appeal and location and their gut feeling of what's it going to be like to manage and own this building and me drive here to pick up the rents, because most people buying those types of units are going to self-manage, and I'm going to recommend that they self-manage as well at first. And then as you grow, and again, because it's your first stepping stone, you're going to branch into bigger stuff. At that point, we're going to recommend that you bring in a property manager to help oversee that. So smaller decrease in prices with the 4 units. Again, there's still demand, but sales are definitely down there for sure.
Got it. And the Fed just had their meeting in August, and they said it's time for a rate cut. So what do you think is going to happen with the 4-unit pricing as rates start to come down?
They're going to go up. The prices are going to go up. And I know there's been all this talk for years that we're in a bubble. Prices are going to collapse. Get ready again. Owners are going to lose their shirts. I mean, all these things that I hear, I see it on X, and which is Twitter. And there's all these like naysayers when it comes to where values are going. We're not seeing any of that. I mean, yes, values did drop a little bit, but no one's really losing their shirt. When we're talking about the 5+ folks who have a decrease in value by 25%, well, they've also had this massive increase in appreciation. So all we're saying in that situation, they're not making as much money. Mm-hmm. They're still making money. All of them are making money, right? Now, granted, if someone recently bought, they bought it that, they bought 5 years ago. And well, even if you bought 5 years ago, you're probably still making money if you made the right business decisions in your apartment building. And so even then, like for my opinion, there's no wave of foreclosures coming. You can't find them. No one's going to lose their property right now for the most part. And I'm talking Southern California. I don't want anyone to say, hey, well, we're experiencing something different in Florida, where I see inventory is massively up just on the single family home level. We're not really seeing any of that here in Southern California. So if interest rates drop, that's going to be great for owners. And in fact, Cody, listen, I have owners that are saying, hey, Juan, I'm going to wait to list my property for when they drop. What do you think is going to happen with interest rates at 5+4, whichever you want to handle?
So it's interesting. They've already come down. So really just on the news that the Fed was planning to cut in September, we've seen the 10-year Treasury bill come down, and we've also seen interest rates come down. Actually, I got a quote this morning from Phoebe with Sage Trust Mortgage, and she, like a week ago, was quoting 6.375 on a 5% down loan program for an owner-occupied buyer who wants to buy a small multifamily. And today, rates for that same loan are at 5.99. So just under 6. And this is before the Fed has actually cut any rates. So it's really, the interest rates are dependent on the bond market, and the 10-year Treasury has been slowly coming down. So it's positive news. If the Fed doesn't cut rates, I think they'll go back up. But
You know what's interesting? So let's talk seller. It's definitely positive news for a seller.
definitely, yeah.
Is it positive news for the buyer?
Ooh, yes and no. It's still competitive to buy a property, so rates are also going down for their competition. So someone else might be willing to compete a little harder on purchase price now that they have a better interest rate. So it really just depends. I think the time to buy is before rates go down too much, because that's, you're still buying into the market when other people may be hesitant, and you can take advantage of the rates coming down later with a refinance.
Mm-hmm. And so that time you're describing seems like right now.
Yeah, I think right now it's like we're towards the tail end of the high rates that we've seen over the last couple of years, or last year.
Yeah, and so for anyone looking, whether you're looking at a 4-unit building or something much bigger, please give us a call. This is probably the time. I mean, you should have got in sooner, but if you've been following our channel either on the podcast platforms or on YouTube, we've been saying this, that hey, things are going to improve. And let me just go back to where we started off. For Cody, so for someone who buys in the A neighborhood at a 14 times gross, it's believable that it's going to go back to a 16 times. And so when you're an owner and you buy, a 6-unit building in the A neighborhood, you bought it at a 14 times gross rent multiplier, it's going to go, hopefully, at some point back to 16. That's where the real money's being made, right?
Yeah. I don't know if it would go all the way back to 16. That was based on, sub 4% interest rates for 5-unit and up properties. It's possible that it does, but I think there'll definitely be an increase as interest rates come down, right?
Yeah. Now, and I like kind of that conservative approach, but we also know that the next time around, we'll definitely catch back up to where that height was, and most times they even pass it. So, but I get it that hey Juan, that 16.6 GRM was also driven by a 3% interest rate, and we're not quite there yet, and we may not ever go that low. But the fact that we're getting back into maybe high fives, it's definitely promising for sellers. I mean, I think a buyer is going to say, well, it's also promising for me because I'm going to have a lower payment, but our warning there is like, yeah, but if there's more than one buyer, you're going to have to overpay for the property to secure it, which is not favorable for you.
Right. Yeah, exactly.
Cool. Let's go on to our next topic. I know you've been following a few different policies that are going to be on the ballot. Let's discuss them and kind of give our overall thoughts on what we think about that.
Yeah, so lots of political news right now. So last time I was on the podcast, we talked about the balcony inspection law, and there's a new bill. It's AB 2579, where they're trying to extend the due date basically for owners to complete those inspections. So based on the current law, you have to have it done by January 1st, 2025, and now they're trying to push it out until January 1st, 2026. So you'd have a year more time to get this done.
We had some of our clients call the city, and the city said, so like the way this is supposed to work for anyone who's first hearing this is that if you have a 3-unit apartment building or more, And if you have balconies that face the elements, like out, like if they're not enclosed, balconies, stairwells, you're going to have an inspection. And so the inspections started getting really pricey. I mean, on the low end, we were seeing like $800, but then I was getting quotes for like $2,800. And so this is for apartment buildings. HOAs have already gone through some of this stuff. These are obviously larger buildings. And so this this report had to be done, and either that report was going to say, hey, everything's fine with your stairs, you don't have to do anything, or it's not fine, you're given so much time to do the work. And so one of my clients called the city, and the city of Long Beach said, because we're like, okay, so let's fast forward and say we have this report in our hand. Great. Says that we comply, that we don't need to do anything. Who do we turn that into? That was a question I had last time. Mm-hmm. Well, we checked with the city. The city says, we're not going to look for it. In fact, we're not even going to ask for it. In fact, we don't have the staff to monitor this. And so I'm glad that there's discussion and there's a potential that it's going to get pushed off, because I would tell you, from my opinion, 80% of the apartment owners who are supposed to do it haven't done anything about it.
Yeah, I would agree.
Yeah. And so if it gets pushed out, that's great. I think that laws get passed, and, we at our level try to get the word out, but we could only do so much. And obviously the apartment association here in Long Beach does a great job notifying people, but not everyone's going to jump on board. And they're like, wait, I'm going to have an inspection and it's going to cost how much? And it doesn't even mean that they're going to do the work. It's just a report.
Yeah.
It's hard to get people on board for that.
Right. Yeah. I mean, it's a good thing to have done. You don't want your stairs or your balconies collapsing and hurting somebody potentially. But yeah, it is kind of a tough pill to swallow right now to pay $2,800 to have someone just go look at something. So
yeah. Okay. Moving on. What do we got next?
So next on my list here is Prop 33. So this is named the Justice for Renters Act. So this is the third time that there's been a ballot initiative in California where they're trying to repeal Costa-Hawkins. So there was one attempt in 2018 that failed with a 59% no vote. There was another attempt in 2020 that also failed with a 60% no vote. And yeah, this is going to be the third attempt that they try and repeal Costa-Hawkins, which is a really crucial law for property owners, especially people in our business, because it limits how strict cities can be with rent control.
What are they proposing, just so folks know what we're up against again?
So the Costa-Hawkins Act, basically, it does a few main things. So number one, it makes it illegal to put rent control on single-family homes, condos, townhomes. The second thing it does is it makes it illegal to put rent control on new construction, because they don't want to disincentivize, builders. We really need more housing right now. And the third thing it does is vacancy decontrol. So that means if a unit goes vacant, an owner can raise the rent up to market price, right? So even if it's a rent controlled unit, they can still adjust rent up. So if Costa-Hawkins is repealed, those protections go away. So you could have some cities, and actually in California, I think Santa Monica had vacancy control, maybe West Hollywood, and I think San Francisco did as well, where basically if you had a unit go vacant and you were in one of those cities, the city said, hey, you have to keep the rent the same. You can't raise it up to market price.
No, okay, so we're definitely against this.
Definitely, yeah.
And so we have to get the word out. So give us the, what's the proposition again, just so that our listeners know that this is a flat out no.
It's Prop 33. So yeah, make sure to vote no. This is going to be on the ballot in California this year. So this is a really important one to make sure that you get out there and, don't support this one. Make sure you vote no.
And so for some of the people that are wondering, well, why are you voting no? Well, we already have statewide rent control all over California, although a lot of people, even in my industry, don't seem to know that. There is statewide rent control everywhere. And investors call me and say, Juan, that building you're selling on 2nd Street, is that rent controlled? And I'm like, you got to be kidding me. You don't know this? You're an investor? Agents don't know that. Brokers don't know this. It's the weirdest. Appraisers don't know this. And I talk about this. How could they not know that there's statewide rent control? So that's the first part. And so what's happened statewide rent control to me has actually kept values down because investors used to look at a property and say, "Oh, I see the potential. Right now the rents are really low, but the road or the business plan to get from the low rents to the high rents, there was a road to take." And now that road has gotten much more expensive, and it's not even a guarantee. And so then investors are wondering, well, do I really want to buy that building with those low rents? It's going to take me who knows how much money. I can't force anyone to do anything, and maybe I don't want to buy it, or maybe it's worth less. And so it's hurt the owner who's owned this for 30 years. It's been a problem. And so sometimes we're lucky enough to sell a building. There's a couple of vacancies, and so someone could come in, do renovation. And let's not forget the reason why they're doing renovations, Cody, is so that they could get the new higher rent. I just did a renovation on one of my own apartments, $30,000 to remodel the kitchen, the bathroom, the floors, and new paint. $30,000. Cody, back in the day, that would have cost me like under $10,000,
Mm-hmm.
but it's so expensive. So, okay, so now I've spent $30,000. It's a lot of money. I want to charge what a market rent is going for.
Right.
I do not want to, oh, well, the last tenant was paying 1,500. That would disincentivize me from ever making that building better.
Yeah, and that's one of the big drawbacks of rent control. You disincentivize people to invest in their properties. It creates like an artificial shortage of units because people don't want to leave a rent controlled unit that their rent, they know how much it can go up and they want to stay in that cheap unit. And there's a whole host of other things that just aren't great for the community as a whole. What we really need is more housing. So
Right.
if we can focus less on the symptoms of controlling the rent prices and more on the actual problem, which is an imbalance between supply, the number of homes that we have for rent, and the demand, the number of people that want to rent them. If we can address that instead, that would be a much better route to go.
Got it. Okay, so vote no, Prop 33.
Right.
Perfect. What's our next item?
This was in the news quite a bit. It's AB 1840. So this was a California down payment assistance program called Dream for All, I believe. And basically, if you're a first-time home buyer in California and you meet some other criteria, the state is willing to help you with the down payment. So they'll basically lend you the down payment up to 150 grand or 20% of the purchase price, whichever is less. And why this was in the news recently is they wanted to expand this to include undocumented immigrants. So they would be able to qualify for this program. And actually today, so it's September 6th, Governor Newsom, so it made it through both houses and got to the governor's desk. And actually he, what's the word I'm looking for? He vetoed it today.
Yeah,
he vetoed it today.
Wow. So I can't even believe it got through both houses.
I know. That's pretty crazy. It's
okay.
Tax dollars from people who are citizens going to help undocumented people.
Yeah. I'm all in favor of home ownership. And I understand there's going to be I'm all in favor of home ownership, so long as everyone has the option to receive the benefit of that. I was fortunate enough in that my parents who were undocumented and were coached through with some people that kind of helped our family and got them to buy their first house. And I'm glad they did because, when we talk about rents, for the most part, are always going to keep going up. And if you're fortunate enough to be able to buy a house, you're capping your biggest expense. And that's something that I've been saying for years. And so I understand it got vetoed, but for the most part, our show has owned more doors. We want to incentivize people to find a way to first buy a house. And then once you're ready, you've saved up enough or you have equity in your house to go buy units and continue investing in real estate, which we believe is the best investment vehicle out there.
Yeah. Or start off with units. Another great way.
Yes. Yeah. It's kind of a hard sell, but I think to your point, it's probably the best way to do it. The best way to do it is for someone to buy a 4-unit building and live in one of the units. That is, time and time again, some of the most successful clients that we have, that's how they did it. They bought a 4 unit and they lived in it for a year or two or more. And then they moved on to now we have our own house and we have our units. And
Yeah.
then there's been growth from both. Um, what's what's the next thing we have?
So it's an election year, and Kamala Harris, Donald Trump competing. Kamala Harris came out recently and said that she wanted to pass a $25,000 housing assistance if she's elected. So it's not something that's, you know, guaranteed, but I just wanted to get your thoughts on what that might look like if she does get elected, she does get in office, she's successful in passing this. What is this? What are the repercussions of something like this?
Well, let's talk about the benefits.
Okay.
I mean,
Oh, yeah, the
so
benefits.
so the benefits. So you're saying that under this bill, a people who qualify would get $25,000 and they could use that towards buying a property or their down payment.
So it's for first-time home buyers, is what
Mhm.
she's saying, and it would basically be a government grant to help them with their down payment.
Yeah. I I think that tying that in with we're expecting interest rates to drop, I think that it would be terrific for the real estate market.
Yeah, it could be. It could be.
Yeah. What are you seeing that would be?
So we know that there's a shortage of homes available for first-time home buyers, right?
Mhm.
And if the government is giving all of those people $25,000 to go out and buy a home, what I would expect is for prices of those homes to go up by 25 grand, right?
Mhm.
Because everyone's now going to have this extra money. So
Right.
I think it'll be good at the beginning for the people who are first comers, but I think over time, as more people use this program, it's just going to drive prices of first time homes up.
Yeah, and I think this is another issue of what you said earlier that it's not really solving the problem. And it really goes back like, yeah, you're right. It sounds great at first and might get you some votes, probably a lot of votes.
Yeah.
But then at the end of the day, did it really solve the problem? And really, and I don't really know why this is the case, Cody, where we know we need housing and builders want to build. It's expensive to build. Land's expensive. In Southern California, it is. I guess in other places, it's not. And there's all these pushback, sometimes from the neighbors in the areas, but also from the city,
Mhm.
where it's just hard to build. And to your point, that's the real solution. And that's not really, I don't know any politician who's really trying to push that.
Yeah, they've made some progress in California with the ADU law, which is great. That is somewhat streamlined, but I'm actually working on a deal right now. So we have this lot in escrow in downtown Long Beach, and right now it's rented out to a commercial tenant. They use it as parking, and the lease is 2 years. And I was like, oh shoot, like, is that going to be an issue for you if you want to come in and build? And my developer client, actually, you know him well, he was saying, no, it's actually a good thing because it's going to take probably 2+ years to get through the entitlement and permitting process with the city. So 2 years just for him to buy this lot and build on it.
And this is someone who knows what to do.
Mhm.
And this is someone is a very experienced person that has all the right connections. And even him, it's going to take over 2 years to get the entitlements, which would give you the right to build. So it's a very, and that means that someone needs to buy something. In most cases, they're going to have a loan and they have to be able to carry that loan for 2.5 years
Mhm.
before they could ever start building. And then there's another loan, which is a construction loan.
Mhm.
And then I would tell you, I think if we ask 10 people, will construction costs be higher or lower 2 years from now?
I think it's going
They're,
to be higher.
they're going to be higher.
Yeah.
They're going to be higher. So this is it's very difficult. Cody, I talked to a client yesterday. We sold her a 4 unit building, and right, you brought up ADU, so let's talk about that. We knew that when we sold her this property, it had parking in the back that she could build 2 more ADUs in the back.
Mhm.
She's being told that there's a bill. I don't know the bill, but that she could, if she waits and if this bill passes, she could build 4 units behind.
Whoa.
Yes. So I just heard that yesterday, and she said, "Is this true?" And I said, "Let me look into it." And so It might be true. And so all I'm saying, I'm not saying that it's true yet, but it's possible that if you have a property and there's a parking lot, and if you're in California, that the ADU laws could change in your favor. And so yes, for anyone listening, we are in favor of building ADUs. We believe that it's, and listen, it's a small way to try to contribute in making a difference.
Mhm.
But from an investment perspective, what you pay to build the ADU, you'll get that money back in terms of appreciation of your asset, and in terms of increase in cash flow on that property.
Definitely.
Yeah, so it's something that we're definitely pro. So we'll keep you folks posted. Cody, thanks for coming in today. What's the best way, Cody, if someone wants to work with you, someone's like, man, Cody knows what he's talking about. I like him. I like his demeanor. How should they get a hold of you?
So you can reach out to me through the Sage website. That's one way. Or you can check me out on YouTube or Instagram. It's just my name. So at Cody Charnel. Yeah, but I'm happy to help anybody out there who's looking to expand their real estate portfolio.
Perfect. Here at Sage Real Estate, we are monitoring everything. We are involved at the apartment association level. A lot of the organizations throughout Long Beach, we're part of the Long Beach Rotary, and we're giving back to the community, but we follow everything having to do with real estate. And I appreciate Cody having you on and going through everything, all the bills and all the propositions we should be looking out for. And we'll be back again here shortly. Thank you so much.
So thanks, Juan.